Here's a crazy thought. With all the information in the world at our fingertips, endless data, breaking news, expert analysis, why do so many investors still lose money? It often boils down to a single, very human instinct, the hunt for a bargain.
And isn't that the truth? That natural impulse to find a cheap stock, to feel like you're getting something for nothing, is probably the biggest trap in the entire market. It feels smart, but it's a quest that's just loaded with tricks that can lead you straight to failure. We are wired to want a deal, but in the world of investing, what looks cheap on the surface can end up being the most expensive mistake you ever make.
So that's the million-dollar question, isn't it? How do we get past that illusion of a bargain and start finding companies with real, solid, lasting value? How do we build a framework that actually protects us from our own worst instincts? Well, that's exactly what we're going to tackle today. Welcome to another video on investment basics based on the fantastic work of Mr. Majid Butt, who is an accountant, software programmer, and investment researcher. In this video, we're going to build a practical, powerful toolkit to help you distinguish real value from just a cheap facade. And hey, make sure you stick around because there's a crucial 6-point summary for investors at the very end that you will not want to miss.
All right, here's our roadmap. We'll start by pulling apart that cheap stock illusion. Then we'll build our toolkit, one piece at a time. The price-to-sales ratio, the famous price-to-earnings ratio, the super important ideas of book value and cash flow, and then we'll get into the clues you get from takeovers and insider moves. And all of this leads right up to that 6-point investor toolkit. Let's get started. Okay, first section, the cheap stock illusion. We need to understand why cheap can be so tricky. First off, you got to respect the market. Yeah, some studies have shown that lower-priced stocks can outperform over the long haul, but we can't just ignore that the market is, for the most part, pretty efficient. If a stock is trading at a super low price, there's usually a reason. Our job isn't to assume the market is wrong, but to dig in and figure out if its pessimism is just temporary or if it's permanent.
And this gets to a huge psychological trap. As investors, we just get so excited about the future, right? We hear a great story about some revolutionary product or explosive growth, and we start pricing all of that future success into today's stock price. The problem with that? When that growth inevitably slows down or disappoints, the price doesn't just drift down, it gets slammed back to reality. And on the flip side, you've got these boring companies with solid assets that just get completely overlooked, and that creates a massive opportunity for a patient investor. So let's build our first tool. Think about it. Before a company can have profits, before it can have cash flow, before it can even think about paying a dividend, it has to have one thing: sales. Revenue is the absolute foundation of all profit, which makes the price-to-sales ratio a fantastic place to start any real value analysis.
The PS ratio is so simple but so powerful. You just take the company's price per share and divide it by its sales per share. So let's say a stock is $20 and it has $40 in sales per share. The PS ratio is 0.5. What that means is for every single dollar you invest, you are buying $2 of that company's annual sales. It's a really direct way to see how the market values a company's revenue.
And you don't have to take my word for it. The data is just crystal clear on this. A huge study by James O'Shaughnessy looked at data all the way from 1952 to 1996, and the results? They were absolutely staggering. Investing in the 50 stocks with the lowest price-to-sales ratios would have almost quadrupled your return compared to the broad market. And the stocks with the highest PS ratios, they were the worst performers of any strategy he looked at. They actually did worse than super safe treasury bills. The message is loud and clear. Paying less for sales has historically been a very, very smart move.
Okay, so here's the actionable part. As a rule of thumb, you want to look for companies with a price-to-sales ratio below 1.5. Now look, this is not some magic number. You always have to adjust for the industry, right? A software company is probably never going to have a PS of 1.5, but a grocery store might. But as a general starting point, as a filter, it's a fantastic way to find companies where the market is pessimistic, which gives them a lot of room for a positive surprise.
All right, let's move on to our next tool, the one everybody's heard of, the PE ratio. This is the metric that gets all the headlines, but honestly, it's one of the most misunderstood. It's really less of a valuation tool and more like a mood ring for the market.
See, the PE ratio is kind of slippery because it has two very different sides. For us, as investors, it's a quick shortcut to gauge market opinion. Is the stock popular or unpopular? But from the company's point of view, the PE isn't something they earn, it's a number that investors award to them. And don't forget, the P for price is changing every single second, while the E for earnings only gets updated once a quarter. This just means the ratio is constantly bouncing around based on nothing more than pure sentiment.
I absolutely love this analogy because it just hits the nail on the head. The PE ratio is basically a popularity contest. The popular stocks, the pretty girls, they get really high PE ratios. Investors are willing to pay a huge premium for their earnings. But the unpopular wallflowers, they get stuck with low PE ratios. Our opportunity is to find those wallflowers that the market has just unfairly ignored. It's a lot easier for a stock's PE to go from 10 to 20 than it is for its earnings to double.
So how do we actually use this market mood ring? First, use it to find those out-of-favor stocks. Second, just know that lower PE stocks tend to be less volatile. And here are two hard and fast rules of thumb for you. First, a stock's PE should be less than the overall market's average PE. And second, it has to be less than the reciprocal of the long-term bond rate. Now that second one is a powerful check. If the bond rate is, say, 5%, you can get a 5% return with almost no risk. The reciprocal of that is 20, right? 100 divided by 5. A stock with a PE higher than 20 is actually offering you an earnings yield that's lower than the safe bond. This rule keeps you totally grounded.
All right, time to add two more really powerful tools to our kit. We're going to move beyond just sales and earnings and look at a company's real tangible assets and the actual cash it's generating. Think of these as our asset test and our truth serum. This is how we get down to the bedrock of a business.
Let's start with book value. A great way to think about this is as the 5 a.m. value of a company. It's what all the physical stuff, the buildings, the factories, the land, the equipment, is worth before a single person even shows up for work. It's the tangible, measurable asset value of the business.
But, and this is a really big but, book value is not perfect because it completely misses some of a company's most valuable assets. I mean, think about it. Where on the balance sheet does the incredible value of Coca-Cola's brand name show up? It doesn't. What about the brilliant coders at a software company or the expert bankers at an investment firm? Nowhere. These are unbelievably valuable intangible assets that book value just completely ignores. So, we use it as a guide, not the gospel. And that brings us to the truth serum of investing, cash flow. See, reported earnings can be massaged by accountants. The rules allow for all sorts of weird adjustments. But cash is cash. It's just a much more transparent number because it isn't affected by things like depreciation. It tells you the real, honest story of how a business is performing. And this leads to a super simple, almost foolproof test you can run. Just ask, does the company have more cash and cash equivalents on hand than it did at this time last year? If the answer is yes, it means one beautiful thing. They took in more money than they spent. That's the ultimate sign of a healthy business. And that cash growth is what fuels everything we as investors want to see. Future dividend hikes, stock buybacks, and it makes the company a really attractive target for an acquisition.
Our last set of tools moves from the hard numbers to the softer, qualitative stuff. We're going to learn how to read situations and human behavior to find an edge. This is all about learning to think like a business owner, not just a stock picker. Now, just speculating on takeovers is a dangerous game, but thinking like a potential buyer is a brilliant way to analyze a company. Ask yourself, why would another company want to buy this business? Maybe it's sitting on a mountain of cash. A buyer could pay a premium, use the company's own cash to help finance the deal, and end up with a great business for cheap. Or maybe the company is a critical strategic piece in an industry chess match. This whole perspective forces you to see value beyond just the ticker price.
And finally, let's talk about following the ultimate smart money, the insiders. There are two key things to look for here. First is high ownership. You want to see the management team and the board members owning a big chunk of the company, ideally over 15%. This means their interests are perfectly aligned with yours. Second, look for unusual buying. Look, insiders might sell stock for 100 different reasons, to buy a house, pay for college, whatever. But they only buy for one reason. They think the stock is going up. And when you see several insiders all buying around the same time, that is one of the most powerful positive signals you can ever get.
Okay, we have covered a ton of ground. We've pulled back the curtain on the market's illusions, and we've put together 4 powerful sets of tools. Now, just as I promised, let's put it all together into a clear, actionable 6-point checklist you can use on any potential investment.
So here it is, the whole shebang, your 6-point investor toolkit. Let's walk through each one and really lock in the why behind each rule.
Point 1, word for word, price/sales ratio below 1.5. Okay, why this rule? It's because sales are the raw material for profit.
If you make sure you don't overpay for a company's revenue, you're buying into a situation where even a small improvement in profit margins can lead to a massive surprise in earnings. And that's what drives a stock price higher.
Point 2. Price/earnings ratio less than the average and less than the reciprocal of the bond interest rate. Think of this as your discipline checkpoint. It keeps you laser-focused on those out-of-favor, less volatile stocks, and it's a critical defense against getting swept up in a market bubble. It forces you to ask, is this stock cheap compared to its peers and cheap compared to the safest investment out there, bonds?
Point 3. Price/book value lower than the market, the lower the better. This one is all about your margin of safety. When you buy a company's assets for closer to what they're actually worth on the books, you're building in a safety net. If your big idea for why the company will grow doesn't quite work out, you still own solid, tangible assets. It's a lot harder to get hurt falling out of the basement window than it is falling out of the penthouse.
Point 4. Seek cash greater this year than last year. This is just the simplest, most honest test of a business there is. Forget all the accounting tricks. Did the company end the year with more cash in the bank than when it started? If the answer is yes, then it is fundamentally a successful operation. It proves they earned more than they spent, and that cash is the fuel for everything good that can happen next.
Point 5, takeover possibility, based on financials or strategic fit. Now, this isn't about wild gambling. It's about changing your mindset. It forces you to stop thinking like a stock trader who's just watching a ticker and start thinking like a private business owner. What is the total strategic value of this company to someone who might want to buy the whole thing? That perspective can uncover hidden value the market is totally missing.
And finally, point 6. Insider activity. Increased buying is more important than selling, more relevant to small stocks than large ones. This is the ultimate vote of confidence. When the people who know the company's operations, its challenges, and its opportunities better than anyone on Wall Street start putting their own hard-earned cash on the line to buy more stock, you absolutely have to pay attention. It's one of the strongest signals you can get that they believe good things are coming.
So there you have it, a complete toolkit for finding true value. The question is no longer what's cheap. The question is what's valuable. And now you have the framework to answer that question for yourself. So the only question left is, which company are you going to analyze first?